Welcome to Key Points for February. This month, what the coronavirus means for our macro view, what's next for the financial markets, and what does the earnings season have in store. Now, turning to our first point, not only does this coronavirus have a significant human impact, but of course it also has an economic one. It comes at a bad time. Consumption and travel will be impacted during what was the holiday season, and this will have a spillover effect more globally. And of course, it comes at a time where global growth is already very weak. We saw the GDP numbers for Q4 showing contraction in France and Italy. And in the United States, even though the headline number appeared pretty good, when you scratch beneath the surface, consumption was rather weak, as was business investment. So the global economy is ill-equipped currently to cope with yet another shock. Now, the Chinese are providing a lot of liquidity, and once this virus is contained, there's likely to be some pickup. But this confirms our view that global growth will be in decline through the course of 2020. 2020 will be weaker than 2019. Now, turning to our second point. Last month, we had become more cautious on the equity outlook, feeling that markets had become very stretched. The momentum had been significant, but positioning was becoming a little overdone, and we saw that there was downside ahead for equities versus government bonds. Now, while this has transpired largely as a result of the views around the coronavirus, the fundamentals were still pretty weak, and we do think there's a little bit further downside ahead. But we're not yet calling this the end of the cycle. We think that is likely to come perhaps later on in the year as the economics show this weakness that we've been speaking about. But still a little bit downside, more volatility to be expected. Now, turning to our third point, the earnings season, which of course will impact that market view. Analysts had reduced their earnings estimates very significantly. But when we look at the reportings that have taken place so far, about half of the S&P 500, for example, we see that earnings are still not really having the same beat ratio that they've had in the past. So in other words, despite that lower bar, earnings are still very anemic. And this is not just in the United States, but we're also seeing this in Europe and other parts of the world as well. So as a result of that, we still think that stock valuations are very high, and indeed some valuations are at or even above where they were in the 2000 dot-com bubble. And this think creates a vulnerability further out. In the short term, however, we don't think that this earnings season is going to provide the fill-up to stock market sentiment that many investors had hoped for. So still, we think a rather anemic growth outlook for earnings. Remember, as always, you can read our full investment insights for February on zurich.com/MSME, along with all our other publications.